Welcome to CEO Money. I'm Michael Yorba. Thanks for joining us. I've got Patrick Bourbon, founder of Bourbon Financial Management, on the show with me today. Patrick, welcome to the show.
Hi, Michael. Happy to be here.
Glad you are. All right, Patrick, please tell us about your investing experiences.
Well, Michael, it's my passion for investment started when I was just 12 years old. I grew up in France, and at that time, I had the chance to visit the open outcry at the Paris Stock Exchange. It was an impression I will never forget. Around that time, I was given a $2 bill, and my mother told me that almost every day I went to the bank to check the value of this $2 bill, because in France we had French francs, and I wanted to trade to see, am I going to make some money out of it? By the time I got to college, I loved math and physics, and so I decided to study for a master in engineering. I aim to have a different background, a training. During my studies, I interned in banks like JP Morgan in Paris. I opened an investment club, and I started to manage a portfolio. In 1999, I had the chance to come to Chicago. So I relocated to Chicago. I had a job, and I went to business school in the evening. In 2000, after about a year, I had an opportunity to join UBS Global Asset Management. So during 10 years, I was a stock analyst and a mutual fund manager. I had a great experience with really top people, but in 2009, I decided to have my own firm, so I created Bourbon Financial Management around the time of the crisis when stocks were very cheap, and we decided to create a business that was different. So we wanted to create a financial planning firm to help Americans, but also expatriates, to make better and wiser financial decisions with conflict-free advice. So that's what I've been doing now for about 10 years.
Congratulations. All right, Patrick, tell us about your views on active investing versus passive investing.
Okay. So one of the most important decisions you will make about your investment is asset allocation, how much you put in stocks, bonds, real estate, cash, euros versus dollars, for example. But once you have made this decision, you have to decide what kind of products you want to invest in. So you have to make a decision. Do you prefer active or passive investing? So a passive investment is a product like a mutual fund or an ETF that is typically cheaper because the product is going to replicate an index. So you don't have to have 20 people trying to find the best stocks and doing all this research. So many people invest in passive investment, especially in the last 10 years. It's growing very fast. You have top professors, like in Chicago, Professor Fama, who demonstrate that it's very, very hard to beat the market, that markets are efficient, so no point to try to do this research and try to beat the market. So that's one type of investment, passive. The other types are active investors. So you're going to buy a mutual fund and pay a higher fee because you're going to hire portfolio managers, stock analysts, which what I used to do. And those people are going to analyze cash flows, statement, balance sheet, income statement, travel to see the CEOs, the CFOs, and try to find those better stocks that may outperform. So when you have an active funds, maybe you're going to outperform. So that's why people are buying active funds potentially. They think we're going to outperform the market over the long term. We have a great portfolio manager in Chicago, at Harris Associates. He's managing the Oakmark Fund. If you look at the performance of this fund since 1981, so it has been a while, the money invested in it was multiplied by 26 times until 2018. If you had just bought a mutual fund or an ETF replicating the S&P 500, your money will only have grown by 13 times. So you do have some managers that have some skills, like Warren Buffett, etc. So that's one potential reason why you pick an active manager. You want to outperform. Another reason is you want some protection during market downturns. So some mutual funds tend to buy those type of companies more defensive that will help you to outperform index fund during downturn. The problem is you have to pay a little bit more to have access to those funds, and you have to do research because most of those active managers underperform. Some research will show you that 80% of them may underperform over the long run. And many of those that outperform, maybe it's by luck. So it's very difficult to pick an active manager. You have to analyze the people, the team. You have to understand the process, the investment process. Do you do a discounted cash flow? Do you do a PE analysis? How do you make buy and sell decisions? You have to analyze the firm. What type of firm is that? Do you want to invest in a publicly traded company or in a private firm where everybody is a partner and they eat their own cooking? So you have those qualitative factors you have to analyze. And of course, you're going to analyze quantitative factors like how high are the fees? What is the 10 years rolling returns? Do you really generate alpha over a 10 years period? Because you have to be very patient if you have an investment in an active manager. What's the downside capture? This type of statistics may help you pick better active funds.
I get it. That's great. Now, there's another facet to this, and that is this. There's a fiduciary and fee advisor specializing on expatriates that you wanted to talk about. And just for the viewing audience, most of them probably know, but for those that don't, let's go into those topics.
Okay. When you are looking for a financial advisor, the first decision to make is, do you want to work with a broker or a fiduciary? A fiduciary is someone who works in the best interest of the client. It's very different than the traditional brokers. So that's the first step. The second step that we recommend to check is, how is this advisor compensated? Most advisors get paid fees and commissions. We are very against commissions. We believe that if you receive commissions when you make a recommendation or when you buy a product, you're going to have a big conflict of interest. So a group of financial advisors, it's a smaller group. It may only be a few percentage of advisors belonging to this group. We are called fee-only advisor, meaning we refuse commissions because we don't want this conflict of interest. So that's the second decision to make. We believe you should pick a fee-only advisor. The third decision to make is, do you really want to pay an advisor a fee, typically like a 1% fee, based on the asset under management? We believe that you should not pay an advisor an asset under management fee. We believe it creates conflict of interest. I will give you some example. Let's say I was in France. I was 50 kilograms, and I used to get a full health checkup and pay maybe 50 euro. Now I'm in Chicago. I love those deep dish pizza. We eat much more in Chicago. Let's say I'm 100 kilograms now. Should I pay my physician 100 euro because I'm bigger? Not really. It's like when you hire an accountant and you tell him, I made $50,000 and I pay you $200 for my returns. But then next year you had a big promotion and you made $100,000. Do you want to pay the accountant 2 times more, $400 instead of $200 just because you have a bigger salary? The last example that I have against asset under management is, let's say we are in 2009, you go see your financial advisor and you say, look, I'm going to retire in 20, 30 years, so I want to buy only stocks, ETF, mutual fund, individual stocks, but I really want great returns over the long term. So let's say you give him $1 million, he charges you $10,000 per year. Today we are in 2018, and your portfolio double in value. So you have $2 million. Do you really want to pay this advisor $20,000 per year now? It may be the same portfolio as last year or very small difference. Why do you pay him so much? But the main difference, or the main point I want to make is the stock market since March 2009, if you had picked any kind of US ETF trying to mimic the S&P 500, those type of very passive investment, very cheap, they have quintuple, meaning the total return of the S&P 500 since March 9, 2009 is around 430%, I guess. So you quintuple your money. Your $1 million should have become $5 million today, but your financial advisor only doubled your money. From 1, it went to 2 million. So from our point of view, it destroyed $3 million. You should have had 5 million. So he did a terrible job. Why do you want to pay him 2 times more what you used to pay him, especially since he did a very bad job? So we believe that you should not pay a fee based on the asset under management. We believe in a model called a flat fee model, a retainer model. You pay your advisor the same fee every month or every year, so that your advisor does not have all those conflicts. He can tell you, go buy real estate, go reimburse your mortgage. You have so much money right now invested at 2% in very low yielding strategies. Maybe you reimburse your mortgage, which is maybe at 4%. That's maybe a good trade for you. Maybe you don't want to invest as much money today. Stock market is kind of expensive today in the US. Bonds are a little bit better, but they are not cheap. So maybe you want to keep more cash right now because you have some projects, some investment you want to do in your house or buy a new car. So you want to be able to tell your clients, keep money in cash, buy real estate, reimburse your mortgage, send money to France because you want to buy the euro, which is not too expensive, because you want to retire 3 months per year in France, especially maybe in winter time when you don't want to spend so much days outside with cold Chicago. So we believe in this type of compensation model. And our specialty also, you have to find an advisor that understands you. So, for example, more than half of our clients are expatriates. So it could be Europeans living in the US, or it could be Americans living in Europe or in Asia. Those people have the same type of issues as domestic Americans living in the US, but in addition, they have currency issues. For example, the euro versus the dollar, or the currency that was there before the euro. If you look at the last 40 years, it moved between 0.7 to 1.7. So when the exchange rate goes up 50% higher, if you didn't think about the exchange rate, even though you made good investment in the US in US dollar, maybe in euros it's not going to be that great, and your retirement income is not going to be that great. So that's the type of question you should be asking when you look for an advisor, Michael.
Got it. Patrick, thank you so much for your time today. I get a much better idea of what it is that you're doing now.
Thank you, Michael. I really appreciate the opportunity.
Mine too. Mine too. And hopefully you can get to France and get out of those cold winters in in Chicago.
Yeah, so we do go to France or to the Caribbean every winter, meaning it's very hard to spend November to April in Chicago. For those who don't know, lots of snow, very cold days here.
I understand. All right, you've been watching CEO Money with Michael Yorba. Thanks for joining us. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.